Hi guys, in today's video I'm going to be talking about liquidity because this is one of the most important things that you can learn about trading, and it's something that completely changed the way that I trade and look at the market overall. Before I would open the chart and I would still know a lot of things, but I will have no idea where the market wants to go or how to properly time the market. So because this is very important concept, as I said, I'm going to be making two videos about it. The first video is going to be more about what is liquidity, how to spot it on the charts and where is it located. And the second video is going to be more about entries, what's the overall market goal and phases of the market. So I hope you enjoyed this video. If you have any questions, please let me know in the comments and I'll try to answer them the best way that I can. So let's begin. Okay, so in today's video I'm going to be using the blackboard to explain what actually liquidity is. So to explain it in a very simple way, liquidity simply equals money. So whenever there is a transaction on the chart, there is going to be liquidity. But because this is a very broad statement, we're going to filter this down a little bit more so we can try to make some use of it. And we're going to give you three main examples where the liquidity is resting on the charts, which is going to be stop losses, limit orders, and market orders. Okay, so every single time when there is an area in the chart when these things are likely to be placed, you have to assume that there is a liquidity. Now to narrow this down even more, there is certain patterns that retail likes to trade that institutions or algorithms like to use in their advantage in order to grab the liquidity. So one of the most common patterns is going to be double top and double bottom, or relatively equal highs, relatively equal lows. So I'm just going to explain it in a second. So if you're familiar with the trading and you ever placed a trade before or learn anything about trading, this is one of the most common patterns that you're going to see, which is going to be double top. So basically if the price is going up, it's going to reach certain level and it's going to sell from there. So the next time the price is going to reach the same level, the retail is going to assume that the price is going to sell again. Same here. If the price is on a downtrend, it reaches a certain level, goes back up, then comes back again, the retail is going to assume that every single time that the price touches this level here, it's going to buy again. So we can assume that if you are trying to sell here, if you're selling from this line, you're going to put your stop loss above the line. And if you're trying to buy here, you're going to buy from this line and you're going to put your stop loss below the line. What did we say that stop loss means? Stop loss equals what? Equals liquidity. So what the market is going to try to do, it's going to push up, take all these stop losses, and then it's going to sell down again. And here as well, it's going to push down, take all these stop losses, and it's going to push back up. So with this movement here, not only that we took the stop losses from these areas, but we also induced sellers. Because if you're a breakout trader and you see that the price is breaking this line here, you're going to be thinking the price is going to go lower and you're going to be press sell. And now when you press sell, you're giving opportunity for buyers to buy for a lower price, and then they're going to push it up the same way here. Also the same way with these two examples. Relatively equal highs and relatively equal lows, same. So there is going to be a lot of liquidity resting above these areas, and you're going to see a lot of times price coming up, taking that liquidity, giving opportunity for institutions to sell their positions, and it's going to go shoot down and opposite way here. Now the next very common area where the liquidity is going to be, it's going to be a trend lines, which is called low resistance liquidity. So if you are retail and you see that price came here, jump from here, next time came here again, it jumped from this level, you're going to draw this line and you're going to assume that the third time the price comes to this level, it's going to buy again. So a lot of retail is going to press buy here. What's going to happen is that the price is going to go up, it's going to come down, because the stop losses from these people that press buy, it's going to be below this area. It's going to take all these stop losses and it's going to push back up to the range. The same way on the opposite direction. I hope I don't have to draw. So this is called low resistance liquidity. Now there is another thing which is called buy side liquidity and sell side liquidity. So you have to understand that above every swing high and below every swing low, there is liquidity. So when we break the area, this is called buy side liquidity, and this is called sell side liquidity. I don't even know why I'm using this board, because my handwriting is terrible. Anyway, so if you are a regular retail trader, every single time that you break a swing high, for you this is gonna be called break of structure, and you're gonna go and press the buy, right? Same here. If you're a classic retail trader, every time you break the low, you're gonna see this as a break of structure and you're gonna press the sell. So now what's happening? Knowing that algorithms, institutions, hedge funds, whatever, you're giving them opportunity to trick you, right? So a lot of times, if you are on an uptrend and you broke this area, they know that above this area, you're going to look at this as a break of structure and you're going to press buy. When you press buy, you're giving them opportunity to offload their positions here so they can push the market lower. That's why you have to look at the reaction above every single high and below every single low. You don't have to think that because we just broke the low or broke the high that we're gonna continue the trend, or that it's gonna be market structure shift or whatever. You have to look at the reaction, because a lot of times you will see that the price will just make this kind of candle. It will just wick above this area, trick buyers to go up, and then it will shoot down. Or it can even close above that area. It can even have 2 candle closes below that area. And then the next thing you know, the next candle is just going to shoot back down to the range. And now you're stuck in this long position. Now they can push the market lower. Same way, the opposite way. If we are on a downtrend, boom, we broke the low. Now the people are going to enter, sell here. Their stop loss is going to be above this high. What's going to happen is that the market is going to shoot straight back to the line, have a little pullback, and then boom, reverse. Now we are stopped in the sell position. What you have to understand that every single transaction consists of buying and selling. You can imagine if there is like a big institution or somebody wants to buy, let's say $50 million worth of gold. They're not just going to enter the market and be like, yeah, I'm just going to press the buy button and let me buy 50 millions. No, they're going to make the market conditions that make sense for them to buy for lower prices. And not only that, but they also need someone that has to sell their positions to them so they can buy it. Because I cannot just decide to buy 1,000 pairs of shoes. If there is no 1,000 pairs of shoes, I need 1,000 people who wants to sell me shoes so I can buy it. Now, what I'm going to do to make these people sell me shoes, I'm going to make them think that their shoes are not valuable. You know, if you remember, for example, in 2019 with this virus, what happened? The prices of real estate went down like crazy because people were panically selling the apartments because they were thinking that everything is going to crash, so they didn't appreciate the value of their apartments. So all these rich people, they came here and they were like, yo, let me buy all of these things. And now, like 8 years later, you cannot buy a studio for like, I don't know what crazy amount of money. The same thing here. If the price breaks the level, a lot of people are going to be selling here, which is going to give opportunity for institutions to buy for lower prices, and now they're going to push harder to the opposite side. So above every single high and below every single low, there is liquidity. So you have to wait for the reaction. I cannot stress this much about it, but this is the most important things. Just because we break the level does not mean the market is going to continue, or you got a break of structure, market structure shift, or whatever. You have to wait for the reaction. Engulfing candles like this, after we break the level, this is break of structure. Then you wait for the pullback, you enter, and then we go higher. This above the level, it's not break of structure. This is called liquidity. Grab. And you need to stay away from this. That's why you should almost never trade the breakouts. You should trade only breakouts if you have experience and you can recognize what's actually liquidity grab and what's actually the continuation. Now, after I explain these things, we have to cover more areas where there is liquidity. So above and below previous day's candle. So if you go on your chart and you open daily, you're gonna have a candle and you're gonna see, you have to pull these two lines and there's gonna be liquidity above and liquidity below. And you're gonna see a lot of times if the market wants to reverse, the price is gonna open, push up, grab this liquidity, make wick, and then it can push lower, right? So this is one area. The second area is gonna be sessions. So as you know, there is Asian, London, and New York session. You have to think about these three sessions as, I don't know, like three brothers. They're always trying to do something to set each other up for a movement. So let's say if you are in the market and this is Asian session and Asia opened and started to go down. A lot of times what you're going to see is London is going to open, it's going to continue down, grab liquidity, go back to the range. So this is London. Just to set up a movement for a New York that's going to continue higher, grab this liquidity from Asia. So you can see that Asia's low was grabbed by a London, Asia's high was grabbed by a New York, and price continued in the opposite direction. So every single day you have to use sessions. For me, this was also a game changer. Before I would just open chart and I'm like trading whenever, and that makes no sense. You have to see what's happening. Today Asia is trying to go lower. Okay, let's see when London opens. Let's see what they are trying to do. Are they breaking any lows or highs? Are they ranging? And stuff like that. Now, this is very important part as well. If you have the market pushing down, it came to a certain level, right? And then it started recovering here. Made a higher low, higher high, higher low, higher high, higher low, higher high. You're gonna be like, yo, amazing, we're recovering. We literally pushed above this swing high and we're going higher. all these people that enter their positions here, 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 guess where their stop losses are? They're here, they're here, they're here. So what is this called? This is called engineered liquidity. Look how many stop losses are here below these areas. Do you actually think the market is just gonna go up from here and leave this opportunity to grab all this liquidity? Sometimes that's gonna happen, but to be honest, from my experience, very rarely. Market will go high, push above this high, induce buyers, because again, for buyers, this is called break of structure, right? And then what's gonna happen is you're gonna see something like this, big wick, boom, back to the range, and the same way that we went up, even faster, we're gonna come back down and take all this liquidity with little to no pullbacks, literally. And then after this liquidity taken, and all these people are literally tired and they have no energy anymore to participate in the market, now you're gonna see that price is gonna reverse with big ass candles and it's just gonna shoot back up after it took all this liquidity. So in 90% of the time, whenever you see that market is perfectly respecting highs and lows, like perfectly, you know, it came here, reacted off of this supply, reacted off of this supply, demand, reacted off of this demand, or break and retest or whatever, this is leaving so much liquidity down there that it can just shoot back down, take all this shit, and then it can go up and actually actually make the right move. And last thing I want to talk about is, if you have a classic example of expansion, let's say the market is clearly making higher highs and higher lows, you have to think about liquidity like a fuel. So if you're driving a car, you have to stop to the gas station to refuel, right? You cannot just go with a full tank forever. You have to stop to grab some more fuel so you can continue with your trip. The same way with liquidity. The price can only go as high until a certain point where it runs out of the liquidity. What happens next is the price has to pull back and grab the liquidity, right? So a lot of times the price will go back down below this low here. This again will induce sellers to sell, because for them this is going to be break of structure, right? If you were in a long position, let's say from here, if you see this break of structure, you're going to close your position because you're going to be like, yo, we're going to reverse now. I don't want to lose my profits. So you're going to close the position here. And what market likes to do is push back up, react off of some area here, give a little retrace, and then boom, continue higher. These sellers here trapped. This guy that was very smart and opened the position here, he had to close, and now the market can go up and continue whatever it wants to do. I think that's it for this video. In the next video, I'm gonna go to the chart and show you a lot of examples and show you some trades that I took and how to actually use these things in your advantage. And I hope you enjoyed this video. Leave any questions in the comments and stuff like that, and have a good day.